Hello everyone, I am Ms. Bhuvaneshwari, Assistant Professor, PG and Research Department of Commerce. So today we are going to learn an important topic in cost accounting, which is marginal costing. Introduction of marginal costing is a technique of costing fully oriented towards marginal decision making and control, and marginal cost being a technique can be used in the conjunction with any method of cost ascertainment, and it can also be used in such as budgeting and standard costing. Marginal costing is a technique of costing that helps managers make a better decision. So it is not separate method like job costing or process costing. Instead, it can be used along with any costing method. So, marginal costing is mainly focused on how cost change in with output. So, marginal cost means the additional cost of producing a one more unit. The formula for marginal costing is equal to prime cost plus total variable overheads. Prime cost is nothing but direct material, direct wages and direct labor plus the total variable overheads is equal to the marginal costing. So the next important concept and terms used in marginal costing. First one is fixed cost. Fixed cost, it is a total of all those costs which are termed a period cost or the time cost. They do not depend on the volume of production and sales. They must be incurred irrespective of actual activity or the operational. For example, it is an office rent or the factory rent. So they said fixed costs are those that remains constant irrespective of level of production or sales. Next one is variable cost. Variable cost which increase or decrease in the proportion of output or sales. It says a variable cost change in proportion to the level of production. These are called the product cost or marginal cost. Examples are direct material and direct wages. Next one is contribution. Contribution is the difference between sales and marginal costing. So it is the contribution towards fixed cost and profit, and marginal costing technique contribution is a very important concept as it is used to find the profitability of a product. It says the contribution is the difference between sales and the marginal cost. It represents the amount available to cover fixed cost and profit. The formula for contribution is sales minus variable cost. Next one is profit volume ratio. This is the ratio of contribution to sales. It is an important ratio analyzing the relationship between the sales and contribution. The profit volume ratio shows a relationship between the sales and the contribution, and it helps us measures the profitability. A higher PV ratio means a higher profitability and the lower PV ratio means lower profitability. The formula for PV ratio is contribution divided by sales into 100, or a sales minus variable cost divided by sales, or fixed cost plus profit divided by sales. Next one is break-even analysis and a break-even point. Break-even analysis is a method of studying a relationship between revenue and cost in a relation to a sales volume of a business enterprises. So it says this the break-even analysis studies the relationship between cost, volume and profit. So the BEP is the level of sales where a total cost is equal to a total revenue. That is why it is called as the no profit or no loss point. The formula for break-even analysis in units is equal to fixed cost divided by contribution per unit, BEP in rupees, fixed cost divided by PV ratio, or BEP in rupees, BEP in units into selling price per unit. Next one is margin of safety. Margin of safety. Break-even analysis includes the cost of margin of safety is the difference between the actual sales and the break-even sales. So it says it shows how much sales can drop before the business reaches the break-even point. It represents the safety for the firm. So using the formula for margin of safety in rupees is equal to actual sales minus break-even sales, or you can find out in units profit divided by contribution per unit in rupees, profit divided by PV ratio. So now the marginal cost equation, sales minus variable cost is equal to the contribution and fixed cost plus profit is equal to the contribution. Total the marginal cost equation is sales minus variable cost equal to fixed cost plus profit. The statement of marginal cost is sales, sales value less a variable cost, we can get the contribution, and again we can reduce the fixed cost, we can get the profit value. Let us solve a simple problem to understand this more better. So the problem is find out the profit volume ratio and the break even point. So the given values are sales is rupees 4 lakh, variable cost rupees 3 lakh, fixed cost rupees 40,000. So here they are asking a PV ratio and the break even point. First we find out the profit volume ratio. PV ratio is equal to contribution divided by sales into 100. So first we find out the contribution. Contribution is equal to sales minus variable cost. Your sales value is 4 lakh and the variable cost is 3 lakh. We can get the contribution is 1 lakh. So now we can find out the PV ratio. PV ratio is equal to 1 lakh divided by 4 lakh into 100. We can get a PV ratio is 25%. Now we can find out the break even point. In amount, formula for break even point is equal to fixed cost divided by PV ratio. Fixed cost value is 40,000 divided by PV ratio is 25%. So we can get the break even point in amount rupees 1,60,000. So, marginal costing is a useful decision making tool for the management. It helps in determining the break even point, margin safety and profitability. I hope this session helped you understand the key concept clearly. Thank you for watching.